Hi folks, welcome to another episode of Who Said What. I'm your host Krishna. For those of you who are new here, let me quickly set some context for what this show is about. See, the idea is that we'll pick the most interesting and juiciest comments from business leaders, fund managers, and the likes and contextualize things around it. Now, some of these names might not be familiar, but trust me, they are influential people, and what they say matters a lot because of their experience and background. So, I'll make sure to bring a mix. Some names you'll know, some you'll discover, and hopefully, it'll give you a wide and useful perspective. With that out of the way, let me get started. Sankaran Naren of ICICI Prudential is one of India's well-respected fund managers. He recently gave an interview to NDTV Profit and there are a bunch of interesting things he said. But there's this one quote from him that stood out for us.
The way we have managed to become strong in services, we have to become stronger in manufacturing. Is there any country which has become strong in both? The answer is no.
Now we have to ask ourselves, is this really true? See, manufacturing has declined across the world. It fell from 19% in 1997 to 15% last year. Much of the world seems to be deindustrializing a little too early. Now, there are only a handful of sizable countries in the world where manufacturing makes up more than 20% of the GDP. China and Vietnam are on top, around 25% mark. There's Japan too at 21%. India's share has reportedly stagnated over time, but our early success in services, especially IT, is well known. Services has increased its share of the world's output to 66%. It makes up a whopping 80% of the US's output, while for China, it's 60%. For Japan, however, that number is around 70%. If we assume somewhat arbitrary numbers, China and Japan contradict Naren's quote. Let's take the veil of the numbers though. Both Japan and China have global e-commerce giants in Alibaba and Rakuten and well-established telecom sectors. China has also had their own fintech revolution and a huge tech sector that includes ByteDance, Huawei and DeepSeek. However, Japan imports most of their IT needs as their domestic software industry is weak.
Japanese tech providers will always remain dependent on software imports from companies like IBM or Microsoft.
If services just meant IT and tech, then Japan would be excluded. But even then, what does this decline in manufacturing even mean? Both China and Japan have soared in GDP per capita compared to India. Their services output could be more valuable in absolute terms. More importantly, the share of manufacturing is expected to fall as a country gets more productive. It does need to move resources to more high-value activities at some point. But this might imply one other thing. More productivity would make goods cheaper faster than services, meaning that, relative to services, goods may add less value on paper. Economist Biswanath balanced out this price effect and concluded that India might be doing better than mere stagnation. Now that's promising. But the point of this is to show our ideas of economic strength in certain industries can sometimes be arbitrary. The notion of being good at two very different industries at once sounds very attractive. But what if those two industries take resources away from each other? What should be measured is how India builds capabilities over time and the choices we make in the process. VIP Industries is going through a huge shift. The Piramal family, the promoters behind the company, are slowly stepping aside. They just agreed to sell a large chunk of their shareholding, which is around 32%, to a private equity consortium. An open offer will soon follow, allowing other shareholders to sell their shares to the same group. This is, in short, a complete regime change for the company. Now, what triggered this change? The company's chairman, Dilip Piramal, recently gave a surprisingly candid interview to CNBC 18. He spelled out the company's 5-year-long crisis and the hard math that went behind the shift. Now he's still proud of the company he has built, of course, but he says,
India is the only country in the world where Samsonite is not a market leader, even today.
This is true, but VIP's lead is also fragile. And as customer preferences change, they're finding it hard to keep up. As Mr. Piramal says,
my Bangladesh factory is such a great source of soft luggage, And of course, the market for uprights, suitcases, has shifted drastically from soft luggage to hard luggage. So that has caused us problems.
Now demand patterns are changing. VIP's existing capacity is built for stitched fabric cases, but that's not what Indian customers want anymore. The company needs to make major investments and retool itself. But looking at its past trajectory, that seems unlikely.
So we've continued our market leadership. But in the last 5 years, we have not been doing well. we've had a management, I would say, crisis in the last 2-3 years. And our market shares are going down.
That compresses a messy timeline. 3 managing directors have quit since 2021. All through this time, the company bled market share to its rivals. Analysts now peg its slice of the organized luggage pie at roughly 38%, down from 47% just 4 years ago. This also showed up in the company's share price, as Mr. Piramal explains.
That is the sort of tragedy. 2 years ago, the share price was 700, market cap was 10,000 crores. And we got an offer for that price. But my management at that time felt that in 6 months or in 1 year, the share price will go up by 50%. If not, and in 2 years, even 100%. Unfortunately, that hasn't happened.
Things just didn't work out.
The professional management is not being able to run it well for the interest of the shareholders. I think we needed a change of management with change of ownership.
But the biggest problem perhaps is the fact that the rest of the family simply isn't interested in taking over. As Mr. Piramal says,
The younger generation is not interested in the management. So what do I do? And there is a theory of Peter Drucker, who used to be the father of scientific management, modern management in the 50s. So he had a very good theory that by the 4th generation of family businesses, they either degenerate or they lose interest. And that happens very often. So there was an absolute need, in my case, to have a change of ownership and management.
but here's the big question. Can private equity do any better? Sridhar Sivaram, the investment director at Enam Holdings, has been openly critical of India's life insurance companies for a very long time. I remain bearish on insurance, he said in a recent interview with NDTV Profit.
I remain bearish on insurance for simple reason, that very opaque industry. Nothing that they disclose are actual numbers. Everything is estimate. So embedded value is an estimate. Their profits are an estimate. They are not actual profits because they have assumptions on their expenses. So nothing is real.
Now think of embedded value as a guess of how much profit an insurance company might make in the future from the policies it has already sold. And here's the reason he gives for this consciousness.
The number of lives covered for the top 4 life insurance companies last year fell by 30%. I still don't have an exact answer why they have fallen so much. These are not normal numbers. You don't suddenly reduce 5 crore people have lost their life insurance cover. Why?
Now that's true. In FY25, around 5 crore people lost life insurance coverage, nearly a quarter of all lives covered the previous year. Now that's not a rounding error, it's one of the steepest year-on-year declines ever. In the past, such a sharp drop in coverage usually happened only during major shocks, like the COVID pandemic when economic disruption forced insurers to pull back. But this time, there was no such trigger. It wasn't a pandemic or a sudden regulatory ban. Instead, it was a self-inflicted crisis rooted in the collapse of microfinance-linked group insurance. Now, I am not an insurance expert, but if he is right that embedded value is full of assumptions and isn't a reliable metric, does that mean number of policies sold is a better yardstick? Now that seems intuitive. Fewer policies equal to less coverage, which equals to shrinking business. But in the case of life insurance, that logic breaks down because not all policies are equal. What fell by 30% last year wasn't high-value individual term insurance. It was mostly group-linked credit life policies. See, a group-linked credit life policy is basically what lenders bundle with loans. For example, if a microfinance institution gives a 30,000 loan to a borrower, it might automatically attach a small 1-year life cover to it. That counts as one life covered. These are short-term, low-ticket and tied directly to the loan life cycle. Once the loan ends, the cover lapses. So when lenders slow disbursements or insurers find the segment unprofitable, volumes drop sharply. But here's the thing. While group-linked credit life may bring volume, it contributes little to the revenue. Just for context, take HDFC Life's FY25 product mix. Over 60% of its annualized premium equivalent or APE comes from just 2 categories. Participating policies, which are traditional saving plans with bonuses, and ULIPs. But maybe there's more nuance to what he's saying that we don't know. That's it for this episode. If you have made it this far, please let me know if you have any feedback for me in the comments below. For those of you who are new here, let me quickly set some context for what those Services has increased its share has increased. हो रहा है भाई. Services has what should be measured is how India builds